This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Hi, this is Louis Llanes with WealthNet Investments, and this is part 3 of a 3-part series on the role of technical analysis in portfolio construction and position sizing. In this one is titled Integrating Technical Analysis in the Portfolio Management Process. So in this particular video, I'm going to be talking about developing indicators for return, risk, and correlation, and how to make that work in a whole process, and how to standardize and transform those indicators so we can have a common language when we're integrating with fundamental analysis and macro analysis or any other discipline that you're using in your portfolio management. And then what are the key conditions needed to make a trade given the process, and how we know when, what the top reasons are to trade. And then also I'm just going to finally wrap up and talk about where technical analysis can add value in the entire portfolio management process, really kind of wrap up the entire 3 videos. So let's go ahead and dive in. So the standardization process is step 3, and this is one of my favorite parts of it, because this is really kind of the secret sauce to help us talk to each other in our processes. And that starts off with a couple of different processes. One is to transform your indicators. We want to transform them. Sometimes we need to have them really be in a fashion so that they're normally distributed. Our indicators are normally distributed so that we can apply parametric statistics to them. Or sometimes we need to deal with outliers and the distribution problems, skew, instability in the results, so that we can have more robust indicators. So that's the transformation part of it. And then we have the rescaling. So once we've transformed our data, then we need to rescale it in a way that they can talk to each other, so they mean the same thing. So if we have a 1, for example, as a rating, the 1 means the same thing in the technical world as it does in the fundamental world. So that's the rescaling part. And the goal is to make the indicators comparable. Maybe we're Winsorizing and we're limiting extreme data, or maybe we're z-scoring, rank ordering, percentiles, quartiles, things like that. Okay, so now that we've done that, then we have something that we can talk to each other on. Now this chart is an example of looking at Grubhub, which is a stock that I had talked about on a particular research outfit, and this is kind of showing the technical indicators and how they played out. And this is actually showing 2 composite multi-factor technical indicators. One is a relative strength score, that's this blue line, and the other is a momentum score. And what they are is they're multiple time frame, multiple data set, multiple types of indicators transformed and rescaled to 1 through 5. Okay, and when they both go bullish at 3, they're both really on all cylinders, and now they're heading towards the neutral zone on Grubhub. So that's the concept. The concept is to have these types of indicators that can add value from a technical perspective to the fundamentals. So we looked at Grubhub from a fundamentals perspective. We looked at the fact that they were growing, that there was strong demand, that they were helping out the restaurants, that the restaurants really liked to work with them, that their technology was integrating well. All those fundamental things were a go. And then, the technicals were a go. So that gives you a higher probability, hopefully, that you have a better investment opportunity. Now, I want to talk a little philosophically about portfolio management in general, because I think it's important when technical analysts are dealing in the investment management world. There's really 2 extremes out there, and I call this the arrogance-ignorance continuum. Not to be critical of any particular person, but just to kind of show the extremes that could exist and talk about the real world. Now, first, on one hand, we have one extreme that says only the fundamentals matter. And that extreme says, look, I can look at these investments, I can look at their sales, their earnings, their 5 Porter forces of competition. I can look at all these different things, and I can figure out how attractive this is. I can run discounted cash flow models that I learned. I can run growth rates, and I can discount rates, and I can figure out what fair value is and tell you whether or not this is attractive. And I don't care what the market's doing. My analysis, that's it. That tells you what the price is, okay? That is what I consider probably the most arrogant way of thinking. It's idealistic. And the main reason is because we can't know everything, right? Then on the other hand, we have the what I would call maximum ignorance. They say, I want to be ignorant to the fundamentals. I don't care about the fundamentals. Only price pays. That's all that matters. And I'm only going to watch price. That's it. and I'm going to follow the trends, and I'm going to manage risk, and that's it. That's what I would consider the maximum ignorant phase, right? So you have maximum arrogance, maximum ignorance. Most portfolio managers portfolio strategies, I should say, fall somewhere in the middle, right? And you just need to know where you are right there. Now, by the way, there are portfolio managers in either camp, as we know, that are extremely successful. It works for them, right? There's flaws in my mind in terms of their abilities, in terms of what it actually means, and whether or not they're right. In my opinion, that there's a lot of value in price alone. Otherwise, I wouldn't be using technical analysis. In fact, many of the academic studies are actually showing there's a lot of value in price analysis. And then, there's also value in the fundamentals. Value does work. Quality does help with risk. It does matter what the accruals are. Those types of things do make a difference. So, again, where are you in the philosophy? So, where are you? Basically, what I'm trying to say is we need to be able to communicate together in different disciplines. And what I'm talking about, is a way for us to do that. So step 3, integration process. This is how we talk to each other. Other disciplines need this to integrate at the same scale. For example, I'm going to use in this example 1 through 5. And we can look at the fundamentals and the economics, the macro, and go from there. Now, we want to quantify our risk, return, and our diversification. So we can use non-numbers, like we could use qualitative information that we find in our research, but it's best to turn that into a number. So, is it a 3, neutral, or is it a 5, extremely bullish, or is it a 1, extremely bearish? And, just use those ratings to actually help them talk and quantify. So we want to basically integrate by optimizing, and I'm going to get a little bit now into the kind of the nuts and bolts of this. We want to optimize strategic weights so that we're assuming equal opportunity, or if you will, from an academic perspective, equal Sharpe ratios, if you will, return over risk, as a strategic weight. So meaning that if we start off with a neutral zone, let's just assume that everything has an equal opportunity, then what does a portfolio look like given certain volatilities and correlations? That's kind of a strategic way of looking at things and going from there. Once we've established that, then we can overweight, underweight, and we can change the portfolio construction based on our inputs. And we adjust those weights. For the more attractive instruments, we put more capital on them. For the lower attractive instruments, we put less capital or out entirely. So just to illustrate that, I'm going to dive into an example. Here is an equity portfolio process. This is our kind of really, really high level look at stocks, how we kind of view the whole stock world. And it's really broken up into 4 areas. You've got the quality on the very top, which is uncertainty of fundamental drivers, competitive advantage, financial strength. Those are the 3 main categories. There's lots of things inside of that, but those are the 3 main categories. And then we have growth. We have our valuation, I should say. And valuation is a function of earnings or free cash flow, the growth rates in the net assets. So capital versus how much you're earning and how fast you're growing. So those are all 3 main areas that have lots of subcategories, right? And then from the left side, we have the technical side. And there's 3 main categories that we're looking at. One would be the trend, the tendency towards moving higher or the tendency towards moving lower. The other would be relative strength. How is it performing relative to other asset classes? And then, or other stocks or other bonds within its asset class. And then the other would be the sentiment. Is our market participants extremely pessimistic, extremely optimistic? And what does that mean for future prices? And then we have kind of the construction of the portfolio, right? The portfolio construction was what we're talking about here. Diversification, risk budgets, and rebalancing. Those are the 3 main areas. What is the diversification of it? How do we manage our risk budgeting? And when do we rebalance? And when do we make changes to the portfolio? So from a high level, we're doing this. We're integrating these stocks. We talked about the fact that we have these risk exposures and the correlation, right? And we went over that. So, just graphically, this graph here shows a hypothetical of 3 stocks that have overlapping fundamentals, right? So they're going to tend to have a certain amount of additional risk to the portfolio because of these overlapping fundamentals or risk exposures. So once we've identified all that, right, we've got this kind of strategic weight based on everybody has an equal opportunity to do well, right? And now we're making some changes about who could do better and who can't do better. So we want to change that into what I call a signal to weight algorithm. Signal to weight, which means our overall signal telling you 1 through 5 based on all of our disciplines, right? And then turning them into a weight. So the way that I like to do this is to convert those signals to specific weights by mapping them to risk scalars and mapping them to risk budgets. So basically, depending on the risk of the instrument, then we have a risk budget that we can go up to, kind of your maximum risk budget that you can have. And then based on your opportunity score, that tells us how much of that risk budget we can fill. The better the opportunity score, the more we can fill in that risk budget. And then what we do is we apply our constraints at the group level, at the individual security level, and we need to make sure that the overall portfolio is congruent with the risk profile, the total risk profile, okay? Then we finalize our target weights. That's the general overview of it. And so I'm going to use a hypothetical here. I'm going to use a simplified hypothetical that shows mapping the risk scalars to the maximum weights. I'm going to go through each step. So first step is we match the risk scalar. So let's say after analysis we have a average risk. The indicator is average, right? So given an average, our overall risk scalar is going to be 1. So 1 is average, and at 1, we're going to allocate 5% of our capital employed, okay? Not risk capital, but capital employed. So that means 5% of the overall portfolio goes into that. That's assuming that you're fully invested. You're like at maximum return expectation. So now that brings us to the next step. Our opportunity scores then are now mapped to that risk category. So in this case, if we were on a 3 and we were at an average risk, if our opportunity score was 3, for example, and we were at average risk, then we would only be putting half of our capital in. Of that 5%, we'd be at 2.5%, right? We're not maxed out to the 5, right? We'd have to have a 5 strong buy in order to have full gas pedal on, right? So that also then it has to be adjusted, right? For that we've already adjusted for correlation, in a sense, right? Because we've already looked at the portfolio from its diversification effects and strategic weights. Now we're adjusting those strategic weights. All right, so basically we have this risk indicator, we mapped the risk scalars, we've defined it, and we've determined how we're going to weight our instruments. And once we've done that, we've gone through those steps. We've done step 1, risk forecast, step 2, correlation forecast. We derive the strategic weights. Then we apply the opportunity forecast to derive the preliminary weights. Then we make adjustments to the constraints, right? Then we make the final adjustments. And then the last thing that we do is we monitor the tolerance band. So we have this target weight, and then we give it some room. And roughly, we give it about 50% room. So, if you have 5%, then it could be up or down 2.5%, and it's okay, something like that. So you want to be able to give the instruments room to breathe, but at some point, you don't want to let them drift too far, because then you get pulled out of your risk budget. You can have some problems there. So that's the last part, is monitoring the tolerance band. So again, you got to have a look at your time frame, and I can't stress this enough. This chart shows this because I really want to stress this, that the longer your time frame, the more room you need to give the instrument, and the smaller the position size given your risk profile. So what this shows is just a simple standard deviation multiplier based on the number of days of your time frame. So it starts off really low, and then it goes really, really high, 12 times, 16 times your daily volatility. You would need to leave it room to equal 1 standard deviation room. So you really have to have a view of that. In general, how am I going to size is proportionate to your time frame. Okay. Now, this chart here just shows kind of a hypothetical example of 2 stocks, stock A, stock B. Let's say stock A has a return risk, 30% return, 30% risk. Stock B, these are both stock A's. The second one down there, stock B. 50% return at 50% risk. If we're risking 1% of capital, right? We're risking 1% of capital. Given this, and we have no diversification effect, you can see the weights would be different. One would be a 3.33% weight. Stock B would be a 2% weight. And if you put both of them together in the portfolio, you would have a total open risk of 2%, because you're risking 1% on both of them. So 1% plus 1% is 2%. That's your open risk, is your total risk in the portfolio. And that assumes no diversification, right? It's just purely, I'm just simplifying this just to kind of show the relationship. All right, now let's move on to step 5. Step 5 is implementing the trading. Here we're dealing with tolerance bands, and the benefits to this is we want to limit the risk of individual securities to the overall portfolio and gain better control of our drawdown. So we want to have tolerance bands. The costs to tolerant bands have to do with taxation, transaction cost, impact costs, and also the fact that you reduce exposures of your largest winners sometimes. Because if you have, let's say, an Amazon that was doing well for so long, it keeps bumping up on the top end of the range. You keep paring it back, topping up and paring it back. And you can go back with hindsight bias and go, oh, I should have just held the whole thing and let it drift way out. But if you had done that, your risk profile could be violated. So that's the point of them. All right, so then we have, the other thing that technical analysis can really help with is trading algorithms. Mean reversion trading algorithms. Now that we have a signal, now we actually have to get into it. There's ways at the micro level to actually help with execution, and technical analysis is really uniquely designed to help with that, to help with micro patterns, VWAP execution, short-term algos to enter larger position size to minimize impact costs. And this is really, really a larger subject, but there's this whole concept of adaptive market hypothesis where markets are changing as participants are seeking an edge. It's kind of the survival of the fittest, algos fighting algos. I was talking to a trader who worked for a large institution who all he did was just execute trades for the firm and for the client's firms, or the firm's clients, and, billions and billions of dollars of execution every day. And he's like, I'm fighting algos. I've got algos to fight the algos, just trying to figure it out. But technical analysis can help in this. All right. Now I want to talk about taking action and the 4 types of trading action. There's really, in our estimation, 4, kind of the way we look at it. We either initiate a new investment, or we're adding to an investment, or we are reducing an existing investment, or we're exiting an investment altogether. Those are the main things that we can do, right? And there's 3 primary reasons that we're going to change our target allocation. The first is the risk profile. So the relationship between normal volatility and our time frame. If that changes, then that's going to change our risk profile. So if volatility is increasing to a level that is beyond that's changing the risk profile of our portfolio, that will lead us to take some actions. If the second one is if a specific instrument has a change in the return or risk profile itself. So a specific stock or specific bond has higher risk or lower risk or different diversification situations. That's going to change. That could lead to a change in the portfolio. And lastly, has to do with systematic or non-diversifiable risk. So if we have market risks are increasing or decreasing in general, that could lead to adjustments to the overall portfolio. So it's really important to be clear about when you're going to do something so that you're not taking action just from in a non-disciplined way. Okay, so now that we've gone over a lot of the information, I just want to summarize again in this slide the position sizing protocol and how technical analysis can be used along the process and throughout the process, I should say. So first we have the opportunities starting on the left-hand side. We score the opportunity from a technical perspective, and then we use our risk budget employed. That tells us what our risk budget employed should be. And then we have a risk budget established for the total, right? And that is really gone through planning and figuring out how we're going to bring that down to the individual security level, group level. So we have a risk budget that we're going to have for each individual opportunity. The opportunity score and the risk budget risk score tells us what we can do total position-wise. Then we actually look at a diversification process, and from there we get our target weights. And then those target weights are actually monitored on an ongoing basis with tolerance bands and actual weights, and we just constantly look at that. If the drift is too high, then we rebalance it. It's kind of a cost-benefit analysis, and that leads to actions. That's the overall process of position sizing, just to summarize. So now, where can quantitative technical analysis add value? It really is in 5 different areas of the portfolio process. Number 1 would be defining and monitoring portfolio risk. Technical analysis is uniquely positioned to help analyze the statistics to establish and define the risk profile. Okay. Number 2 is factors of return, risk, and diversification for individual securities and among groups. Okay. So, technical analysis helps us really with the observable price action and to help us understand over various timeframes what kind of risks can be involved and when returns are probably going to be potentially better or worse. That's important. And how is diversification being transpired? Is it getting better or is it getting worse? And what can we do about risks? Are they increasing or decreasing? Step 3, technical analysis helps with the standardization process. How can we make things more robust and comparable between disciplines? Technical analysis has a role there. It also has a role in the signal to weight algorithm, how we convert our analysis into an actual weight. And lastly, it really helps us in actually implementing trades at the micro level, dealing with liquidity as we enter, as we exit. Technical analysis in the nitty-gritty is helpful because it analyzes the supply and demand at the nitty-gritty level to help get better execution and strive to have lower impact costs. All right, well, that wraps it up. Thank you very much for watching this 3-part series. If you didn't get a chance to see the 2 videos before this one, go check them out. Part 1 is on theory and practice of market risk. We talked about a bunch of different things with risk and how we can actually look at that. And Part 2 is defining the portfolio risk in our portfolio and how we can get effective position sizing. And Part 3 was integrating technical analysis in the portfolio management process and how we can speak a common language and transform our methodology as technicians to work in the entire portfolio process and where we add value in each of the steps in the portfolio management process. I hope you enjoyed this series. If you like this type of information, get in contact with us. You can go to our website at wealthnetinvest.com. Follow us on Twitter and follow some of the stuff that we're putting out. I hope you guys had a great time enjoying this. I enjoyed doing them, and happy in trading and investing.
If you like this information, be sure to subscribe and follow us on Twitter and Facebook. The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals.